$300 billion can vanish in a weekend. Not stolen, frozen by updating a number in a database in Brussels and New York. That's what happened to Russia on the 26th of February 2022. Their gold didn't. 2,000 tons sitting in vaults in Moscow and St. Petersburg, untouched. Russia had been building that position since 2014, quietly selling dollars, buying metal, moving reserves into something no foreign government controlled. The sanctions had nowhere to grip. You've never heard the phrase, "gold has no issuer," in a financial news broadcast. But it's the sentence that explains most of what central banks have done with reserves over the past decade. Gold has no issuer, no counterparty, nobody promising to honor it, nobody who can revoke it, just metal. Every other major reserve asset, dollars, euros, gilts, is simultaneously someone else's debt. Hold a US Treasury bond and the United States owes you money, which means a hostile relationship can make that debt unreachable overnight. Gold is not a debt, it's an object. That single distinction has been reshaping the world's reserves for years. By 2025, central banks held more gold collectively than at any point since the gold standard was abandoned. The same institutions that create paper money were quietly stockpiling the one thing they couldn't create. Every reserve currency in the world is simultaneously another country's liability. When the Bank of England holds US Treasuries, America owes it. When France holds euros, the ECB is on the hook. That liability is what makes the reserve useful and what makes it a target. The 2022 freeze wasn't novel, it was unusually large. The United States had used frozen reserves as leverage for decades. Iran, Venezuela, Afghanistan, Cuba. The pattern is consistent. Cross a line and dollar holdings become hostages. The rule isn't written anywhere, it doesn't need to be. Gold doesn't work that way. A bar sitting in a vault in Frankfurt isn't the liability of any government on earth. It was dug out of the ground. No account to cancel, no counterparty to sanction, no wire to cut. The only way to seize it is to physically take it. This is why central banks have been buying gold at record pace since 2010. 1,000 tons a year through 2022 and 2023, the fastest accumulation since the Bretton Woods era. And the reason is essentially this one fact. It can't be frozen because it isn't in anyone else's system. But to understand why that matters so much now, why it matters more than it did 30 years ago, you have to go back to a hotel in New Hampshire in the summer of 1944 and the deal that ran the world for the next 27 years. 44 nations gathered at Bretton Woods in July 1944 to design the financial architecture of the post-war world. What they built was elegant in its simplicity. The US dollar fixed to gold at $35 an ounce. Every other major currency fixed to the dollar, and any central bank could redeem dollars for metal at that rate. The whole system rested on one guarantee. America would hold the gold. America would honor the window. And because every other currency was pegged to the dollar, that guarantee underlay everything. Every trade, every bond, every loan issued anywhere in the world that touched a major economy. The gold standard imposed discipline. You could print dollars, but only up to the gold you held. Because if you printed more, foreign central banks would notice and walk up to the window to exchange surplus paper for metal. The reserve was the limit, a real physical ceiling on the printing press. For 25 years it held. The Marshall Plan, Korean War. The whole post-war boom ran on dollars that were receipts for gold, and the world trusted the dollar because the dollar trusted gold. But there was one weakness built into every promise. It required the United States to actually keep it. And by the late 1960s, the costs of Vietnam and a decade of expansionary spending had put the US in a position it hadn't wanted to admit. It had printed more dollars than it had gold to back them. By 1971, the mismatch was visible to anyone who looked. Charles de Gaulle had been looking since 1965, distrusting American fiscal discipline, quietly converting French dollar reserves into gold, physically shipping bars from New York to Paris. He was right to be skeptical. The US gold window was draining. Nixon's choice was uncomfortable and simple. Raise taxes sharply to close the deficit and shrink the money supply, politically impossible in an election cycle. Or cut the link to gold and let the dollar float free. He chose the door that didn't require him to explain anything painful to voters. On the evening of the 15th of August, 1971, Nixon appeared on television and announced, in phrases carefully designed not to sound alarming, that the United States would suspend the convertibility of the dollar into gold, effective immediately. No consultation with allies, no warning. The window was shut. Every major currency followed within 2 years. The gold standard, in various forms the anchor of global finance since the 1870s, was gone in a single broadcast. The world now had pure fiat money, no tether to anything physical. Central banks could, in principle, create as much currency as they liked. They understood perfectly what that meant, because they'd watched the system that had constrained them for a century simply stop existing on a Sunday night in August. Gold no longer officially backed anything after 1971. Why did every major central bank keep it anyway? The United States kept 8,133 tons. Germany kept its gold. France kept its gold. Only Britain sold, and only half, and spent the decades after pretending it hadn't. What they understood in 1971 is this: the problem the gold standard had solved didn't vanish when the gold standard did. How do you convince the world to trust paper money? For a century, the answer had been, show them the gold. That answer was gone. The question remained. Gold became an unofficial reserve, not a backing, a signal, a credibility deposit. If fiat money ever started unraveling seriously, a country with physical gold had an alternative. Not a gold standard exactly, just optionality, a floor beneath the floor. Britain's sale is instructive. Between 1999 and 2002, Gordon Brown's Treasury sold 395 tons at an average of $275 an ounce. The gold was unproductive, he said, an asset earning nothing. That gold is worth something over £25 billion today. Gold has risen more than tenfold since. It's known, without affection, as Brown's bottom. Every country that quietly kept its reserves was making the same private bet, that fiat money, unconstrained, would eventually need a hedge. The bet has paid off, and you've been watching it pay off every time you've seen a gold price chart tick upward without understanding quite why. Why does gold's price keep rising? The answer isn't about scarcity. Plenty of things are scarce. Gold doesn't earn interest, pays no dividend, just sits there. From a conventional investment standpoint, it's a terrible quality. So the rising price needs explaining. Gold doesn't go up, currencies go down. The bar in 2025 is the same object as the bar in 1971. Same weight, same purity, same atoms. What's changed is the purchasing power of the paper used to price it. Gold in 1971, $35 an ounce. Gold in 2025, over $3,000. That's not gold appreciating. That's 54 years of paper depreciation. Watch gold at the moment when faith in paper wavers most sharply. The decade after Nixon's cut, the dollar lost 75% of its purchasing power, and gold went from $35 to $850. Not a coincidence. Every time central banks have intervened at scale, 2008, 2020, gold has tracked the intervention, climbing precisely as the money supply expanded. This is what central banks actually dread about the gold price, not the asset, but the signal it sends about them. A rising gold price is the market's real-time verdict on monetary credibility. Every time you've seen gold hit a new all-time high in the news, you are watching that verdict being delivered, publicly, in a number that doesn't lie. Across 5 decades, the market's answer to, "Do you trust the money we print?" has been consistent. Not entirely. And the message has been getting louder. The 2022 lesson wasn't subtle. If $300 billion of reserves can be frozen in a weekend, every non-aligned country in the world was looking at its own holdings and asking one question: what happens if it's us next? The answer came in the form of a buying wave. China had been accumulating quietly for a decade, releasing totals in quarterly filings that consistently surprised markets. After 2022, the pace accelerated. India bought, Turkey bought, Poland added 130 tons in 2023 alone, more than any other single central bank and more than anyone had publicly forecast they would. The repatriation numbers tell the same story. In 2023, 59% of central banks stored gold in their own domestic vaults, up from 41% the year before. Germany spent 7 years, 2013 to 2020, quietly moving its gold home from New York and Paris. Not because it distrusted its allies, because it trusted the metal more than the account. By 2025, gold had surpassed the US dollar as the most held reserve asset globally among central banks, the first time since the gold standard ended. Officially, these are diversification decisions, prudent portfolio management, risk mitigation. What they actually represent is a quiet global bet against the financial system that the same institutions are responsible for running. So what does any of this mean for you? You don't run a central bank. You've got a current account, maybe a pension, maybe some savings held in the currency your government issues. What does Russia's vault in Moscow have to do with your money? Because the gold price is the most honest signal the financial system produces. Every time it hits a new all-time high, somewhere a central bank has just made a decision the market doesn't fully believe. It's a report card issued in real time, and it's been trending upwards since 1971, which means the grades haven't been improving. Think about what gold actually is to the institutions that hold it. Not an investment. They're not trying to make money. Not a currency. They don't spend it. It's a vote of no confidence they cast against themselves, quietly, filed in a vault, never mentioned at a press conference. The thing they can't create is the thing they reach for when they don't entirely trust the thing they can. Russia's gold, the 2,000 tons that the freeze couldn't touch, had been bought with rubles that were losing purchasing power against the dollar even before the sanctions hit. The hedge worked. The metal held. And every central bank watching drew the same conclusion the Russian central bank had drawn in 2014. When the system cracks, the crack runs through paper, not gold. Gold isn't valuable because it's rare. Plenty of things are rare. Gold is valuable because no one can print it. And in a world run entirely by institutions that can print everything else, that distinction is the whole game. The institutions that print the money have been telling you this in tons per year for 50 years. The vault is the confession.